Right now there's money sitting in your bank account that's about to disappear. Not stolen, not spent. Just gone the moment the financial year rolls over. No notification, no warning, no second chance. And the crazy part is most people won't even realize they've missed out because they never knew the opportunity was there in the first place. The date that matters is June 30th. Miss it, and you could be handing thousands of dollars to the tax office that you didn't actually need to. Get a few things right before then and you might keep a few thousand extra in your own pocket. Same salary, same job, same financial year. Completely different outcome just because of what you do over the next couple of weeks. Now I know tax isn't exactly the most exciting topic. It sounds like paperwork spreadsheets and someone telling you to just ask your accountant. But here's the thing, your accountant can only work with what's already happened. The moves that actually save you money have to happen before June 30th, and that's the part that's on you. I've got 6 simple moves that can make a real difference, so let's jump into the first one. The first one is topping up your super before tax, and honestly this is one of the biggest opportunities most people overlook. The concessional contributions cap is $30,000 a year, and that includes whatever your employer has already paid in. Those contributions are generally taxed at just 15% instead of your normal income tax rate, so depending on your tax bracket, putting in an extra $5,000 could save you somewhere around $1,000 to $2,000 in tax. But here's the bit hardly anyone talks about. If your total super balance is under $500,000, you might be able to use any unused contribution cap from the last 5 financial years. So if you haven't been putting much into super since 2021, you could have way more than $30,000 available this year. Some people are sitting on $80,000 or even $90,000 of unused cap space without realizing it. You can check exactly how much you've got through your MyGov account, just don't leave it until the last minute. The money actually has to arrive in your super fund before June 30th, not just leave your bank account. Super funds get slammed in the final week of June, so if you're planning to do this, get it sorted now rather than later. And one really important step. If you're planning to claim that personal contribution as a tax deduction, make sure you lodge a notice of intent to claim with your super fund before you submit your tax return. It's an easy form to miss, but if you don't do it, you can miss out on the deduction even if the contribution made it into your account on time. The second move is prepaying expenses you were already going to pay anyway. Things like income protection insurance, union fees, or even interest on an investment loan. Tax deductions count in the year you actually pay the expense, not the year it's for. So if something is due in July but you pay it in June instead, you bring that deduction forward into this year's tax return. Now this isn't going to completely change your refund on its own, but when you stack it together with everything else it starts adding up. And you're not spending extra money, you were already planning to pay those bills anyway. Just don't go buying things purely because they're tax deductible. Spending $1 to save a few cents has never been a good financial strategy. The third move is for anyone who's worked from home this year, which is a huge number of Australians now. You can either claim the fixed rate of 70 cents per hour work from home, which covers things like electricity, internet and phone, or you can claim the actual costs separately if that gives you a bigger deduction. The important part isn't really which method you choose, it's having records. Even with the simple fixed rate method, the ATO expects you to have a record of the hours you actually work from home. A diary, calendar, roster, timesheets, anything that backs up your claim. If you're just guessing when tax time rolls around, the ATO can reject the whole claim. Spending a couple of minutes each week keeping track is a whole lot easier than trying to recreate an entire year's worth of hours later. The fourth move is one that flies under the radar, realizing capital losses. If you've got shares or crypto that are worth less than what you paid for them, selling before June 30th can lock in that capital loss. That loss can then be used to offset capital gains you've made elsewhere this year. So if you've made a decent profit selling another investment, this could reduce the amount of tax you pay on those gains. Just don't let the tax benefit become the only reason you sell. If it's still an investment you genuinely want to hold long-term, think carefully before getting rid of it. And definitely don't sell it and buy it straight back. That's known as a wash sale, and the ATO pays close attention to it. If they decide the sale was only done to create a tax loss, they can deny the claim altogether. The fifth move is for investment property owners. If you don't already have a depreciation schedule, getting one organized before June 30th can be well worth it. A quantity surveyor works out how much the building and its fixtures depreciate over time, and that depreciation becomes a tax deduction every year you own the property. The good thing is it's basically a paper deduction. You're not actually spending that money every year, but the tax system still lets you claim it. For a lot of investors, it's worth thousands of dollars in deductions each year. The report itself usually costs a few $100s, but for many people it pays for itself in the very first tax return. If you bought an investment property recently and haven't done this yet, it's definitely worth looking into. The sixth and final move is for anyone who's donated to charity this year. Donations of $2 or more to a registered deductible gift recipient are tax deductible, but only if they've been made before June 30th and you've actually kept the receipt. That's where people usually get caught out. They make donations throughout the year, then tax time arrives and the receipts have disappeared into old emails. Or they donated to something that seemed like a charity but wasn't actually a registered DGR, like a GoFundMe, a school fundraiser, or helping out a mate. They're all good causes, but they generally aren't tax deductible. If you've donated this year, take 5 minutes now and make sure you've got those receipts while they're still easy to find. Here's the part that doesn't get talked about enough. Once June 30th passes, that's it. You don't get to go back and fix any of this later. Tax law doesn't really work like that. The financial year closes, and whatever wasn't done before that deadline simply doesn't count for this year's return. And honestly, this isn't just about saving money on one tax return. If you make these 6 checks every June year after year, the savings start compounding, especially with the super contributions growing over decades. By the time retirement rolls around, you're not talking about saving a couple of $1,000s anymore. You could be looking at tens of thousands of dollars simply because you built a good habit. If this video saved you some money, give it a like so more people see it before June 30th rolls around. Subscribe for practical, no-fluff money advice and hit the bell because there are a few more time-sensitive videos coming before the end of the financial year. Thanks for watching, and I'll see you in the next one.